So if you've been watching the Indian markets recently, wow, it's been a sea of red. But those scary market crash headlines, they're missing the real story. The reason for this huge sell-off, it's probably not what you're thinking. So today, we're going to follow the money and find out what's really pulling the strings here.
And yeah, here's what that damage looks like up close. We're not just talking about one index having a bad day. It's a total domino effect. Nifty, mid-caps, small caps, everything's getting hammered. This is way more than just a little dip. It's a massive sell-off, and has everyone asking the same question.
So, what is actually happening here? Is this just the market being the market, its usual ups and downs? Or is there something bigger at play? Well, it turns out the answer isn't in some company's earnings report. Nope, it's connected to something much, much bigger.
And here it is, the real reason for all this chaos. It's not about how well Indian companies are doing. It's about the health of the Indian rupee itself. The rupee has been falling, and falling fast, and that single fact is kicking off a massive chain reaction. And I want you to look at this, because this is not a coincidence. Check out the timing. At 1:50 p.m., the Indian rupee hits an all-time low. And at that exact same moment, 1:50 p.m., the Nifty hits its lowest point of the day. You can't make this stuff up. This isn't just a correlation, this is cause and effect, plain and simple. These two things are completely connected.
And this is the number that's causing all the trouble. 92 rupees for $1. That's a brand new all-time low. The fact that it fell so fast is a huge red flag for the economy. And believe me, it's sending a very, very clear signal to foreign investors.
Okay, so why is this happening now? Why the sudden weakness? Honestly, it's kind of like a perfect storm. First, all over the world, people are rushing to buy US dollars because it feels safe right now. At the exact same time, you've got these big foreign investors pulling their money out of India. Throw in a dash of global uncertainty, and bam, you've got massive pressure pushing the rupee down.
Now, this isn't just some abstract problem for Wall Street, or Law Street, I should say. A weak rupee creates ripples that affect the whole economy. It creates a very clear list of winners and losers. So let's break down who wins and who loses when this happens.
It's actually pretty simple. If you make your money in dollars but pay your bills in rupees, you're a winner. Think about IT companies or exporters selling pharmaceuticals and textiles abroad. They're loving this. But if it's the other way around and you have to spend dollars, you lose. This is bad news for importers, for students trying to study in the US or Europe, and for anyone planning a foreign trip. And you know who else it hurts? All of us. Because things that get imported, like fuel and electronics, suddenly get more expensive. Hello, inflation.
Here's a super simple way to think about it. Imagine an iPhone that costs $1,000. A little while ago, when the rate was 82, that phone cost you 82,000 rupees. But now, at 92 rupees to the dollar, that exact same phone costs 92,000 rupees. That's a 10,000 rupee price jump almost overnight. Nothing about the phone changed, but it just got a lot more expensive. That's a weak currency hitting you right in the wallet. Okay, so that brings us to the big question, right? We know these big foreign investors are selling, but why are they running for the exits so fast? It's not just random panic. It comes down to a really simple and honestly pretty brutal bit of math. First, just so we're all speaking the same language, let's talk about FIIs. That stands for Foreign Institutional Investors. Basically, these are the heavy hitters, huge investment funds from other countries that invest billions of dollars in India. When they make a move, the whole market feels it. All right, now for that brutal math I was talking about. Let's do a little thought experiment. Imagine you're one of these big FIIs. You invest $1 million in Indian stocks when the exchange rate is 82 rupees to the dollar. Now, for the sake of argument, let's say the stock you bought does nothing. The price doesn't go up or down. It's completely flat. But while that's happening, the rupee weakens from 82 to 92. Now, you decide to cash out and take your money home. You convert your rupees back into dollars, and that's when you get a really nasty surprise. Poof. Just like that, you've lost over $100,000. Think about that. Your original $1 million is now only worth about $890,000. And the craziest part? The stock itself didn't lose a single rupee in value. This is the hidden trap of currency risk, and it's exactly why they're selling. I mean, why would you keep your money in a place where you can lose over 10% of it before your investment even has a chance to make or lose money? And it's not just stocks, The same thing is happening in the Indian bond market. They're losing money there for the exact same reason. On top of that, the cost of hedging, which is basically buying insurance to protect against this currency mess, is going through the roof.
So when you can get safer, and maybe even better, returns back home in the US, pulling your money out of India becomes a no-brainer.
All right, so things look pretty tough. That leads to the next logical question. What can be done about it? Is there a way to stop the rupee from falling and calm the markets down? Let's take a look at the options. Well, there are a few tools in the toolbox, but honestly, none of them are a magic bullet. You could try to increase exports, but that's a long-term game. You could try to import less oil and gold, but that's really hard to do. The RBI, India's central bank, can step in and sell its own US dollars to support the rupee, but that's like putting a Band-Aid on a big wound. It's a short-term fix. Maybe the most direct way is to change policies, maybe cut some taxes, to try and tempt those foreign investors to come back, even with the currency risk.
So we've established that a ton of money is leaving the Indian stock market. But where is it going? It's not just vanishing into thin air. When investors get scared, they don't stuff cash under the mattress. They look for a safe place to park it.
And this chart tells the story perfectly. Look at that. Stocks are way down in the red. But where's the money flowing? Into gold and silver. You can see they're both in the green. This is a classic flight to safety in action.
And the logic behind this is super simple. When things get chaotic and currencies are unstable, investors have always run to assets like gold and silver. They're seen as a safe haven. It's a way to protect your money from all the craziness happening in the stock market.
Okay, we have covered a ton of ground here, from how currencies work to what makes big investors tick. So let's bring it all together and boil it down to the most important things you need to remember.
If you remember nothing else, remember these 3 points. Number 1, this whole market crash is being caused by the historic fall of the Indian rupee. It all starts there. Number 2, that weak rupee is wiping out the profits of foreign investors, which is forcing them to sell their Indian investments. And number 3, the money isn't just vanishing. It's moving from stocks into the traditional safe havens, gold and silver.
And that leaves us with one last big question to think about. We're seeing a clear shift, money running away from instability and towards safety. The demand for gold and silver is real. So the question is this just a temporary panic, a short-term reaction, or are we watching the beginning of a much bigger, more fundamental shift in where people put their money?